I have returned from my holiday hiatus. We're going to go over in this video what we missed in that holiday hiatus, the one big thing I see that's super crucial now, and then move into our 2020 forecast and positioning. First, I would like to say that this will hopefully be the last video that I record as a non-accredited investor. We've kept these videos free, and they will be free for the foreseeable future. Tomorrow I'm taking my Series 65. We discovered a hiccup when trying to onboard a US-based client. All my previous clients were foreign. My next client will likely be US-based. That required us to get registered. So we're doing that promptly, and we expect the test to be taken tomorrow and the registration to be filed very shortly thereafter. Nonetheless, let's get back into our market forecast. So what happened during the holiday hiatus? Well, if you saw December 20th, there was a real market capitulation, and energy stocks in particular. Energy stocks were in the mid-epicenter of the Omicron fears, and it seems like Omicron has been taking this market down. We know, you all know how we've been feeling about Omicron from the very beginning, from that day after Thanksgiving, when it first started to hit the market. We have remained rather bullish, and it seems like we are on the right side of that because the market is back at new all-time highs, despite energy not being at those new all-time highs. Anyways, December 20th rolls around, Monday of last week, and we see a big capitulation first thing in the morning. My clients are texting me, freaking out, scared. Should we just sell everything because a massive crash is coming? And this isn't just my clients. This is the broad market. Lots of people are fearing the worst. A massive crash is coming. The market has peaked, and a massive sell-off or massive correction in the double digits is likely to ensue. I saw something about an hour after the open that was more clear in hindsight, but did not result in me selling anything, and that was a tick up finally in the 10-year Treasury yield. Let's look at things on a more macro lens, or through a more macro lens. Something that has occurred that's very important for the market, because we know the Fed has driven the market, and we know the saying, don't fight the Fed. One of the things that have occurred is the Fed signaling that it's going to begin tapering its bond purchases faster and more aggressively than expected. What does this mean? It means the largest player in the largest and most important market, the US Treasury market, and other bonds, is going to begin decreasing its role in that market rather quickly within a few months, it seems. What does that mean for that market? Well, prices in that market are likely to fall because there's less demand, there's less buyers. What does that mean for bonds, though? Yields go up. However, after the Fed announced that, we saw yields fall, right? Doesn't make sense. The market has to adjust for the biggest player in that market leaving. Regardless of what market it is, when you get an announcement like that, you don't expect prices to rise. Shouldn't happen. Just on the supply and demand dynamic. However, there's another force that affects supply and demand for, let's call it what it is, no risk Treasury bonds. Or, no market risk, essentially, no default risk Treasury bonds. And that is fear. When fear is very prevalent in the market, bond yields can fall because there's a demand for a flight to safety. So that seems to have been the prevailing force. However, on that December 20th date, after about an hour into trading, it seems like the fear had capitulated, it had maxed out, and we saw Treasury yields begin to rise out of the 1.3 zone, and haven't returned since, into the 1.4 zone. We're still not really out of the 1.4 zone, but we're approaching the 1.5 zone. Once we get to the 1.5 zone, I expect us to just keep creeping up, and for Omicron fears to continue to just calm down, Omicron dissipate, and COVID overall to lift itself from the market and for yields to continue to push up. Yields, I expect to continue to push up. I am short through an inverse ETF. I'm short US 20-year treasuries through that ETF. Going long that ETF through long leap calls. That's my current positioning. Investment views, not advice here. Although we are not charging you a fee for this view. It just seems like that's a very macro call and very long-term predictable call that has not been consensus short-term, or at least been playing out short-term, given the fear externality, which likely has capitulated. Now, that does not mean that stocks have bottomed and are going to rally significantly from here. I think a rally is possible, and I think it's possible not because every stock deserves to go up, but because there are stocks that are well off their highs that don't deserve to be. Namely, energy stocks. Energy stocks are well off their 52-week highs for the most part. Oil is almost back to its 52-week year and 7-year high. It's not there yet, but given Omicron fading, it looks like it's going to be getting there and possibly even higher. Just given where oil is now, this is still a multi-year high, disregarding the previous high we'd seen before Omicron, right before Omicron, as Omicron occurred, and Delta picked up as well. Yet, energy stocks are well below their pre-pandemic levels. So think about that. The price of oil is above pre-pandemic levels, but stocks are below pre-pandemic levels. So just to catch up to where they, quote, should be, given the price of oil, there's a massive gap there. And you can play that gap and take advantage of that gain, and that should be over a longer period of time. I'm not saying it's going to happen next week. Should be this is not an investment advice, quote, layup. A layup, given that logic, if you follow purely that logic. However, these energy companies have improved themselves in two regards that are very crucial to their valuation and are in part, at least one of the two, keeping them multi-year depressed, basically since 2014, and probably affecting their slope during the 2014 period. So take all that when I discuss these two forces. One is margin improvement. They have decreased costs. They've decreased costs. And when a company decreases costs, they can profit more. And ultimately, what is a stock? It is ownership of that cash flow and earnings and the assets of the company. So if they're improving their earnings, aka their profits and cash flow, via decreasing their expenses, that should be good for you as a shareholder. However, the stock is still below pre-pandemic levels, even if the price of oil stayed the same. However, the price of oil has gone up, and we expect it to continue to go up because we're still in a deficit. Can't go down if there's a deficit. Global demand is increasing, so demand is going to continue to go up. Supply is going up, but not as fast as demand. So we expect to remain in that deficit for the foreseeable future. Some people are saying 2023 we'll get out of that deficit. We are not engaging in those forecasts. We see the foreseeable future. I'm not saying it's not going to be 2023. I'm just saying, I don't have satellites in the sky, and I'm not in the boardrooms of Exxon and Schlumberger. As far as I'm concerned, they've all said they're going to increase their dividends and expect to increase earnings potential, double it by 2027. ExxonMobil, look it up. So I like these energy stocks. I'm holding them, and they're down. So I expect these stocks to rally despite interest rates rising. I think there's a lot of forces there that'll be stronger than a 1.4 to 1.5 to 1.6 to 1.7 to 1.8 impact. Not saying it doesn't matter. If we get to 2.5, 3% on the US 10-year, it's going to matter. Potential. We'll see. But the forces in oil and oil stocks and energy stocks should be able to push through that. Now, the other of the two is specific to some names, but are specific to the names I like the most, Exxon and Schlumberger. These companies are depressed on a multi-year basis because ESG investors, other woke funds, and people who fear the long-term potential of these companies want to sell them. They don't want to own them. They fear that oil's going away and they won't be able to make any money. Well, let's address the oil going away thing. The EIA expects oil to remain the primary energy source until 2050 and for overall energy consumption to increase by 50%. That's the prediction by the government agency. Not going to dispute it. Not going to say it's accurate. I'm just going to share with you the fact that was stated. We'll see if it comes to fruition. The other thing with regards to long-term potential are the other businesses they are engaging in. Schlumberger is investing in water power and water cleanup, among other things, including decarbonizing current operations, lithium mines, and other future energy sources. ExxonMobil is creating zero and low carbon e-fuels, all of which, as far as I'm concerned, are compatible in existing and vintage engines. With the gasoline substitute, this comes and is made from taking carbon existing out of the atmosphere, pulling it out, turning it into fuel, putting it in the car. With regards to diesel, this comes from Camelina plants, partnering with a company called Global Clean Energy Holdings. This is an expanded deal. Starting next year, they're going to have 5 million barrels per year of this fuel. 5 million barrels is an expansion of a previous deal. I expect if they see success next year, they will expand it again. So we like these companies. We don't view them as short-term investments. We are here long-term. We liked them at the end of last year when we made a similar video. We like them again going into next year. We still like our mining companies, and we still kind of like our 10x growth, but wait. We will wait before adding to these positions unless they have already fallen significantly, many of which have. But let's let the interest rate things shake out a little bit because they're going to affect those companies most. And maybe we'll get a real pullback. And on that real pullback, then we would look to add more to those 10x growth companies. If you have some exposure there, I would say just keep it. Don't buy more yet. Don't sell it, okay? These companies, if you have a long-term time horizon, these companies can provide you quite phenomenal returns over a long period of time. You just gotta keep the size proportional to your investment goals and your risk tolerance and play that. Hopefully they fall and you may, given your investment goals and risk tolerance, be able to add some. I and my clients will be doing that. We are not buying now. We are gonna wait to see what the impact of interest rates is on 10x growth, because it's a very, very big unknown. In the 2001 bubble, 2001, rising interest rates popped that bubble. So let's just see if it happens. It looks like it's kind of already happened, but let's give it a little time to play out. So that's today's video. I hope you enjoyed it, and until next time, peace out.